Hi dear traders and investors, welcome to the daily market review from analysts and forecasters from FxCo portal. Let's get started. Will the upward movement continue for Bitcoin? I've got an answer from Artem Petrenko. Bitcoin and the cryptocurrency market continue the recovery movement that originated in the current trading week. The main digital asset managed to make a bullish breakout of the 17K level, and the capitalization of all cryptocurrencies reached $858 billion. The main catalyst for bullish sentiment in the market was macroeconomic factors, as well as the gradual approach of the Christmas holidays. Against this background, Bitcoin resumed its correlation with stock indices. Fed Chairman Jerome Powell's speech was the main catalyst for bullish movements in the most markets. The head of the regulator said that a pleasant surprise on the decline in CPI in October gives reason to reduce the pace of rate hikes to moderate. Powell noted that the first stage of slowing down the rate hike could happen as early as the December meeting. Powell noted that the first stage of slowing down the rate hike could happen as early as the December meeting. However, Powell stressed the inflation is still too high and therefore is likely that the final rate hike will be higher than the Fed planned in September. He also noted the need for more evidence of lower inflation. Financial Times experts decided to finish off the markets with a statement that most of the key indicators point to the achievement of the peak point of global inflation. In the coming months, we should expect a fall in inflation worldwide. Having reached the 17K round level, the price of Bitcoin faced strong resistance from the bears. The cryptocurrency is on the verge of a bullish breakout of the 15.5K, 17.1K range, but technical metrics point to wearing buying positions. Stochastic is gradually forming a bearish crossover pattern, and RSI indicates a decrease in buying activity or a significant increase in bearish pressure. At the same time, MACD continues to move upward, suggesting the strength of the medium-term upward trend. The macroeconomic background and improving investor sentiment contribute to the upward movement of most markets, including cryptocurrency. In the near future, a pause and retest of the 16.7K level is possible, where a local support has formed. To maintain the bullish potential, Bitcoin needs to hold the 16.7K level and gain a foothold above 17 again. Under such conditions, the cryptocurrency will continue to move towards the next targets at 17.6K and 18.2K. The further movement of BTC will depend on the overall situation, since all the positive does not negate a large number of negative factors. The next station is Eurodollar pair. Our expert Laurie Bailey reports. Yesterday, Federal Reserve Chairman Jerome Powell delivered a speech. From his message, it became clear that the Fed will raise the rate by 50 basis points at the December meeting, in order to avoid recession as an effect of the rate hike being too fast, although he confirmed that the tightening period itself may take longer and the final rate higher. Also, according to ADP data, there were 127,000 jobs created in the private sector in October, against expectations of 200,000. As a result, the dollar index lost 0.79% and the euro gained 76 points. Now, the euro will try to break through the nearest resistance at 1.0470 and reach the target range at 1.0615 and 1.0642. Investors are already focusing on the weaker employment data on the economist's consensus forecast suggests 200,000 non-farm. As a consequence, if the price rises quickly, a divergence at a flatter angle is possible. Dashed line on the chart. If the price settles above the target range, the growth may extend to the next target range at 1.0758 and 1.0787 to the support area of April 14-19 and resistance on May 30. But we look at such growth with doubts, since the current growth since September is still correction. On the 4-hour chart, the price crossed the MACD line, and the Martin oscillator has moved into the positive area. We expect the price to reach the nearest range of 1.0470 and 1.0490, where the price was staying on November 28. Staying above the range opens the way to 1.0615 and 1.0642. Of course, if tomorrow's US labor data turns out to be weak. If results come out strong, then the euro might confuse traders in a sideways trend for another 2 weeks, until the third meeting. The next in line is Powell Greco and his review GBP/USD. On Wednesday, the GBP/USD currency pair traded as slowly as the euro. The market did not see any reason to trade actively and trendily here either, although there were few reports relating to the British pound and the dollar. There is currently no reason to anticipate a downward correction because the price is close to the moving average line, and there has not yet been a clear consolidation below it. We continue to think that the pound sterling has risen too much in the last month, and that there are no more reasons for it to rise. As was already stated, there was no response to yesterday's GDP and labor market reports. The polar nature of these two reports may be to blame for this outcome. Simply put, the GDP report was very strong and the ADP report was weak, only 127,000 versus a forecast of 200,000. As a result, netting prevented us from observing the dollar's rise or decline. The number of jobs created outside of agriculture in a single month is roughly the same in both the ADP and non-farm payrolls reports. ISM and S&P business activity reports are comparable, and they hardly ever coincide with one another, just like business activity indices. They frequently differ in their forecasts and actual values, which are frequently revised later. As a result, one should always approach this data assuming that the values may change in a month. First, the ADP report showed a very small increase in employment, only 127,000. As previously stated, a normal value for the American economy is between 200 and 300,000. Although both indicators have not displayed the same dynamics over the past year, the market places a higher value on non-farm. With some expectation, non-farm rates have been falling for a year. Therefore, it's unquestionably false to infer that non-farm will also be weak due to ADP's failure. Volatility is likely to rise, and we still anticipate that the pair will decline. To understand where the pair may move in the future, we advise waiting several days to either a clear and confident overcoming of the moving average or a clear and confident rebound from it. Over the previous 5 trading days, the GBP-USD pair has averaged 132 points of volatility. This value is high for the dollar-pound exchange rate. As a result, we anticipate movement on Thursday, December 1, within the channel constrained by the levels of 1968 and 1.2231. The Heiken Ashi indicators turning downward indicates a new phase of a corrective movement. In the 4-hour time frame, the GBP-USD pair resumed its upward trend. Therefore, until the Heiken Ashi indicator turns down, you should continue holding buy orders with targets of 1.2207 and 1.2231. With targets 1.1841 and 1.1780, open sell orders should be fixed below the moving averages. Our expert Irina Yanina wants to tell us about gold rally mode. Gold prices rose Wednesday as market participants reacted to Fed Chairman Jerome Powell's speech at the Hutchins Center on Fiscal and Monetary Policy at the Brookings Institution in Washington. Market participants listened attentively to his words, hinting at the dynamic changes in the monetary policy of the Federal Reserve System. However, it should be noted that the reaction of investors in general seems to be focused on the fact that they were hoping to hear that the Fed will start raising rates at a slower pace, and not that the Fed will take longer to reach their target. It's likely that restoring price stability will require holding policy at a restrictive level for some time. History cautions strongly against prematurely loosening policy. We will stay the course until the job is done, Powell said. Powell's speech on Wednesday eased investors' concerns as they reacted to other members of the Federal Reserve who announced an upcoming rate hike. In particular, James Buller's recent remarks underscored the Fed's hawkish intent. Last week, he commented on the need to raise the Federal Reserve base rate to 7% to fight inflation. He said this week that the Federal Reserve will likely need to keep its benchmark policy rate north of 5% for most of 2023 and into 2024 to succeed in taming inflation. Powell's statements in no way contradicted statements made earlier by Buller and other members of the Federal Reserve in his prepared speech. However, the chairman was able to deliver the message in a much softer tone. Powell essentially sealed a 50 basis points rate hike at the December FOMC meeting. However, he stressed that a slowdown in rate hikes would require the Fed to maintain restrictive monetary policy for a long period. Gold's recent rally from 1621 to nearly 1800 is a reflection of a major shift in investor sentiment in the market. This suggests that investors are paying close attention to inflation and reducing inflation to restore price stability with a multi-year prices. This suggests that investors are paying close attention to inflation and reducing inflation to restore price stability will be a multi-year process. That's all for today. See you next time. Good luck.